Hello, everybody. It is August 21st, and we are getting ready for another week of trading. And all I hear in the news is Jackson's Hole. And the economic symposium is happening in Wyoming, probably the second worst ski resort in the country, but neither here nor there. This week's economic data, there's basic durable goods orders on Mondays. We always have the Thursday initial jobless claims, PCE on Friday. It's nothing, not major data. I think everybody's just holding their breath for Jay Powell and see what he says on Thursday, Friday. The meeting is Thursday, Friday, Saturday, so looking forward to see what he says, see what the Fed has in mind, seeing what they're seeing in the economy, and I don't think it's going to be anything major, but that is all I'm hearing in the news. So as far as earnings this week, there is not a lot of super big earnings reports. The biggest one I think was going to be Nvidia on Wednesday after the market closes. Before that, we have Zoom, we have Dole, JD.com, Dick's Sporting Goods, Macy's. There is a lot of really neat companies that are having their earnings report, but I don't think any of those other than Nvidia are going to be big market movers. Nvidia is one of the top 10 companies by weighted average, so it does have the potential to move the entire market. So I will be very closely looking at Nvidia on Wednesday. Last week was not a super awesome week, but it wasn't a terrible week either. You can see here the mega caps didn't perform well. They did the first half of the week, but towards the end of the week, you see Microsoft started to fade away. They ended up down 1.97 for the week. Google ended up down 3.69 for the week. Amazon down 3.71. Tesla ended up down 1.12, and Apple, who had been on this massive run, cooled off at the end of the week and only finished down 0.34. A couple of the sectors that were up for the week: healthcare ended the week green, energy ended the week green, and consumer defensive ended the week green. But mostly everything else was flat to down. Not a super exciting week. We did manage to hit, and I'll show you on this time frame. This is the 15-minute time frame for last week. You could see that the risk range that we gave, we ended up getting to the pretty close to the top of the risk range by Tuesday, and then we started to slide down and got to the very bottom of the risk range by Friday. Didn't break below it, didn't break above it. We stayed fairly close to the top of the risk range, fairly close to the bottom of the risk range. I just bring that up just to remind you guys that risk range is based on the VIX, and when you start understanding those risk ranges, then you know that once you start getting to the top end of the risk range, you could start playing the downside. Of course, position sizing and risk management are always key, but if you get to the top of the risk range, you can place a pretty safe bet that we're at the very minimum going to get to the middle of the risk range. Same thing goes to the bottom of the risk range. Once you start getting towards the bottom of the risk range right here, you can place a trade to the upside, understanding that we're likely going to move up a little bit, and we did towards the end of the day. As far as for next week, the risk range based on the VIX gives us a $6.27 range. $6.27 range. We closed at 422.14, so that gives us an upper risk range of 428.41 and a lower risk range of 415.87. Now, the reason I like this is because the reason I like looking at risk range and matching it up with other things is because it does line up. You can see this structure right here. This is going to be acting as support. This structure right here, both these structures are going to be acting as support, and that just happens to be where the bottom risk range is. This structure right here is going to act as resistance, and that just happens to be where the top of the risk range is. that trend line that we've been chasing for weeks, that again is going to act as the upper end of the risk range. The 20-day moving average is going to act as the lower end of the risk range. And then we have max pain on top of that, which is the expected spot where the most amount of options are going to expire worthless. On Friday, that number is at 415, which again is near that 20-day moving average and near that bottom of that risk range. When you have everything lined up that way, then expecting anything more, expecting any drop under 415.87 is a fool's game. That's just the way it is. I know there's a lot of bears out there. There's a lot of really angry bears. And I know there's a lot of very angry bears because I could tell how many puts there is out there. And based on the amount of puts, I know there's a lot of angry bears out there. There's bears out there yelling that this is a market that looks like 2008 or 1973. And they say, look at the chart. It looks exactly like 2008. No, it doesn't. Because in 2008, we never crossed over the 50% retracement line, which we did this year. The second thing is the timing is off. In 2008, we had a spike in July, not August. We're into August now. We're past that volatile month. Now we still have September and October that are going to present a little bit of extra volatility. Yes, that is correct. We have that triple witching that I marked here. It's going to be in September, third Friday of September. And there's always extra volatility, as you can see here. There's always extra volatility during triple witching. That's 3 weeks away. And just to give you a heads up on that, triple witching for September 16th, the max pain's at 410. So if we have a this week's expected volatility of 415.87 and the max pain at 415, and in 4 weeks the max pain is expected to be at 410, that's not a lot of movement between here and there. Now of course that max pain gravitates based on what everybody's doing, but just letting you know, to be bearish expecting more than 415.87 to the downside is you're using too much hopium in your trading strategy. To be bullish expecting more than 428.41 as your risk range, again, using too much hopium. That should be your expected risk ranges. If we get more than that on either direction, then great. That's great if you're playing that direction. But don't expect more than that. I think the likely scenario, well, there's a couple of scenarios. One scenario is going to be, of course, that we're going to play inside this range and just consolidate for a few weeks until we pick a direction. You can see here, we have this little wedge that we're inside of, and it is possible, the other scenario, it is possible that we move all the way towards the bottom of that wedge and then stay inside that wedge, and then maybe September, October, pick a direction. That's possible. That's a little bit too big of a wedge for my liking, but it's absolutely possible. I don't think that a scenario of this week breaking over that trend line is in play this week. I don't see it happening. I think we need to cool off a little bit. That's just my opinion. But I do see this scenario, and I do see this week coming down, maybe coming up a little bit towards the end of the week, and then coming down a little more the following week, and reaching this trend line, which will probably be the 50-day moving average by the time we get there. I do see that playing out in a couple of weeks, but for this week, I don't see more than 415.87. This isn't a bear trend anymore. This isn't a downward trend anymore. So these sudden gigantic drops, I just don't see that happening right now unless we have a major catalyst in the macro environment. because unless there is that major catalyst, I do see a sideways melt. One thing to look at, and we always talk about Fibonacci. When I back tested the 50% retracement, I did notice that the average drawdown after we went over the 50% retracement was about 5%. The average, the smallest one that I saw was 1.5%, and the biggest one that I saw was about 10%. So just to give you an idea, this was the high when we crossed over that 50% retracement up the year's low, and a 5% retracement of that would take us down to, that is the average right there, and it takes us down to about 410. It doesn't have to come in 1 week, so I don't think we're going to go to 410 this week, but just giving you an idea that in probably the next couple of weeks we'll probably get down to that 410. 5% is the average, so we can go all the way up to 8, 9, 10%, which would put us closer to that 400 area. That's the likely scenario. But as far as Fibonacci, if you look at the Fibonacci retracement from the low to the high of this recent run, the 23.6 retracement, look at that, 215.31, and that's pretty close to our lower risk range of 415.87. So I could see us working down to the 23.6. Of course, 38.2 is stronger, but I don't think we're going to get to 38.2 in 1 week. But if we do, that's 405.27, which is the 5% drawdown. This, I say it all the time, the math adds up. You have to measure the market. When you measure the market, you understand your risk ranges, you understand where we're headed, and it makes it easier for you to manage your risk. The market as a whole, if you look at leveraged traders are net short on the market. They still think that we're going to make another pullback. Well, what you have to understand that these leveraged traders, they don't YOLO their accounts. The last time the leveraged traders went short was right here, right around this pop right here. We had a drop. We had the options expiration right there. They closed their quarterly contracts, and then the new contracts open up. When the new contracts open up right here, we have a pop in the market. They start going short on the market. When they start going short on the market after this pop, they're probably only adding about, they're probably opening a position of a quarter of what they're expecting to put into the market. This is right around the 390 area. They start going short on the market. We start going a little bit of sideways. Some of them might have closed it here. Some of them might have closed it here. And then we had this massive run. Well, if they only put in a quarter of their position right here, and we all knew that we were headed for that 50% retracement because we've been talking about it for weeks now, then now that we hit that 50% retracement, those leveraged traders add another 0.25% to their short here. Or they can add half of what they were expecting to put in, which now puts them at 75% of their total short. So coming down to 415.87 puts them in profit and allows them to close that short in profit. Understand, they didn't go all in here. They knew that it could go either direction. But once you get this massive pop, you start understanding this is a different market now. There is no catalyst to the downside right now. So at this point, they add to their position. We know we've been talking about a drawdown in the end of August through September, maybe into October. So now they add to their short here. And by the time that we get close to that 400, they're going to close their position. And when all the shorts start closing their position near the next quarter's expiration, it is going to cause a squeeze towards the upside. I don't know it factually, but I'm guessing that's what's going to happen because it's happened before in history. It's happened multiple times after September, October, where we have these big rallies in the last quarter of the year. It's why we say the beginning of the best 6 months is in November. That is the first of the best 6 months. October is the last of the worst 6 months. So keep that in mind. Remember, this is a little bit of a longer game. Understand your short-term risk ranges. Understand your short-term directional movement. I do think that short-term for the week, we're going to slide down towards the lower risk range. I'll be very happy if we slide towards the upper end of it first and then finish off towards the downside. That would probably give me the easiest trading strategy, because I am still being nimble. I am still being quick. I am still trying to close as many positions the day that I open them. And I wish I was as good as this guy that made $130 million on Bed Bath & Beyond. And I love the way these articles are written. Applied mathematics and economics major, as if he's some kind of genius that made him make $130 million. But I just don't happen to have $25 million to put in Bed Bath & Beyond to be as good as this guy. I hope you do. And if you do, YOLO. If you can't YOLO, follow a trading strategy. Know your risk and reward ranges. Know when you're going to enter. Know when you're going to exit. And make profit daily. If you cannot day trade because your account is not over 25, just remember, put your money on SPY, put your money on a good company, keep it there, and let it add up, let it accumulate. Over a 20-year span, historically, over a 20-year span, if you put money into SPY, you're just going to accumulate. There is no time in history where there's been a bear market or a drawdown that didn't result in an all-time high. Time in the market wins every single time. And with this being the tail end of a bear market, I think this is a great time for you guys to put money into the market and play the long game. If you're not in position to play the long game, then again, reward, risk, stop out if you're playing long and you start seeing getting closer to that 415, well then stop out, because you know that if we start heading down, we're going to reach this 415.87. If we start going up, we're going to reach this 428.41. Understand your risk reward, and good luck to you guys. And if you have any questions, feel free to ask on the HaiKhuu Discord. Please remember to give us a thumbs up and share the channel. Let's share the community and continue to help each other get stronger and better. Have a great weekend, guys, and we'll see you on the Discord.